Imagine a world where you can invest in real estate, stocks, or even fine art, all from the comfort of your living room. Welcome to the transformative world of real-world assets, or RWAs, in the crypto space. These RWAs represent tokenized versions of tangible assets brought onto blockchain networks like Ethereum. They have the potential to bridge the gap between traditional finance and blockchain technology, democratizing access to traditional assets and unlocking new avenues for investment. This is not just a revolution, it's a potential paradigm shift in how we view and interact with financial markets. Remember, nothing in this video is financial advice. It's all about broadening your understanding of the crypto universe. So, what exactly are RWAs? And why are they causing such a stir in the crypto world? Real-world assets, or RWAs, are essentially physical assets that have been tokenized on blockchain networks. Now you might be wondering, what does it mean to tokenize an asset? Imagine a piece of art, a property, or even a commodity like gold. Tokenization is the process of converting the rights to these physical assets into a digital format, creating a digital token that represents ownership of that asset. This might sound like a fancy concept, but in reality, it's a transformative step towards democratizing access to traditional assets. It's like slicing a pie into multiple pieces, where each piece can be owned by different individuals. This process, known as fractional ownership, allows more people to invest in assets that were previously out of their reach due to high entry barriers. Think about it. Not everyone can afford to buy a whole property or a masterpiece painting, but with tokenization, they can own a fraction of it. But the benefits of RWAs don't stop there. They also bring increased liquidity to the market. In traditional finance, selling an asset like real estate can be a lengthy process, often taking months to finalize. However, with tokenized real-world assets, the sale can be as quick as a click of a button, providing investors with quick access to their capital. Moreover, RWAs play a crucial role in the world of decentralized finance, or DeFi. They serve as collateral for borrowing and lending, offering less risky investment options and enabling index funds to diversify their portfolios. If you're not familiar with DeFi, it's a financial system built on blockchain that operates without the need for intermediaries like banks or brokers. However, as with anything revolutionary, integrating RWAs into DeFi isn't without its challenges. It involves a complex process of selecting the asset, valuing it, dividing it, creating a legal framework, developing smart contracts, choosing a blockchain platform, and issuing the digital tokens. And let's not forget the regulatory hurdles that need to be navigated. Despite these challenges, the potential of RWAs is undeniable. They've already started to reshape how we perceive and interact with traditional assets. The total volume locked in real-world asset tokens is over $4 billion, a testament to their growing popularity and acceptance. RWAs are not just a trend, they are a game changer that's reshaping the landscape of investment. They are revolutionizing asset management and opening up new avenues for investors. However, as with any investment, it's important to do your research and understand the associated risks. As we continue to explore this dynamic landscape, the future of RWAs in the crypto space certainly seems exciting. Stablecoins have dominated the crypto space, but how do RWAs tie into this? Stablecoins, by design, are a type of cryptocurrency that aims to keep their value stable as opposed to the significant volatility seen in crypto markets. They achieve this stability by being pegged to a reserve of assets. Often these reserves are made up of traditional fiat currencies like the US dollar, euro, or even a basket of currencies. But here's where real-world assets or RWAs come into play. Imagine a stablecoin backed not just by fiat currencies, but by tokenized versions of tangible assets like real estate, stocks, or bonds. These assets, being part of the real economy, have intrinsic value that can provide a solid grounding to the value of a stablecoin. This is precisely the role RWAs can play in the stablecoin market. The tokenization of real-world assets onto blockchain networks like Ethereum creates a bridge between the traditional financial system and the crypto ecosystem. It democratizes access to these assets, allowing anyone, anywhere, to invest in or own a fraction of these assets. This is a game changer for stablecoins. By using RWAs as collateral, stablecoin issuers can provide a more tangible backing for their coins. This reduces the risk for stablecoin holders as their investments are tied to real-world assets with inherent value rather than just promises of stability. This approach could potentially make stablecoins more appealing to a broader range of investors, including institutional ones. Moreover, the use of RWAs as collateral also introduces a new level of transparency into the stablecoin market. Blockchain technology allows for the tokenization and tracking of real-world assets in a way that's transparent and verifiable. This means that anyone can verify the existence and value of the collateral backing a stablecoin. This level of transparency is revolutionary and could play a significant role in enhancing trust and confidence in stablecoins. However, it's not all smooth sailing. Using RWAs as collateral for stablecoins does come with its own set of challenges. For instance, valuing these assets can be complex, and the legal frameworks surrounding their tokenization are still evolving. Moreover, the liquidity of these assets can be a concern, especially in times of market stress. But these are challenges that can be overcome with time, innovation, and regulatory clarity. In conclusion, the integration of RWAs into the stablecoin market is a fascinating development that is poised to bring about significant changes. By providing a more tangible and less volatile backing for stablecoins, RWAs can help to create a more secure and grounded financial ecosystem in the volatile world of cryptocurrencies. Stablecoins and RWAs together are creating a more secure and grounded financial ecosystem in the volatile world of cryptocurrencies. Let's talk about treasuries and how RWAs are influencing this critical aspect of the financial world. In traditional finance, treasuries serve as the backbone of a company's financial health. They manage cash flow, invest excess capital, and maintain liquidity. Now, imagine if we could infuse this sector with blockchain technology and real-world assets, or RWAs. Fascinating, isn't it? Real-world assets, as we discussed earlier, are tangible assets such as real estate, art, and commodities, tokenized and brought onto blockchain networks. So how can these RWAs influence treasury management, especially in the crypto space? Let's delve into that. Incorporating RWAs into crypto treasury strategies can offer an exciting avenue for diversification and risk management. By holding a portion of their treasury in tokenized real assets, companies can hedge against the volatility of the crypto market. This approach offers a degree of stability, as these assets have value beyond the digital realm. Moreover, RWAs can provide an additional layer of security. For instance, if a crypto company's digital assets were somehow compromised, their real-world assets would remain unaffected, providing a safety net of sorts. This tangible, diversified approach to asset security could be a game changer. Recent developments in the space have shown the potential for this approach. Companies are beginning to experiment with incorporating RWAs into their treasury management strategies. It's a new frontier and, as with any frontier, it comes with its share of risks and opportunities. On one hand, tokenized real-world assets can add complexity to treasury management. Valuing these assets, ensuring their legality, and navigating the regulatory landscape can be challenging. On the other hand, the potential benefits, diversification, risk management, and increased security could well outweigh these challenges. In the end, the inclusion of RWAs in treasury management is a reflection of the broader trend towards convergence of traditional finance and blockchain technology. As the crypto space continues to evolve, the ways in which we manage and secure assets are bound to change. RWAs could well be the next big thing in crypto treasury management, offering a tangible, diversified approach to asset security. How are RWAs shaking up the world of lending platforms in the crypto space? Lending platforms in the world of cryptocurrency have typically used digital assets as collateral, but with the arrival of real-world assets, or RWAs, this landscape is undergoing a significant transformation. Let's delve into how this change is unfolding. RWAs are tangible assets like real estate, art, or commodities that have been tokenized on blockchain networks. They bring a slice of reality into the virtual world of cryptocurrencies. But what makes them particularly intriguing in the context of lending platforms? Well, RWAs can serve as collateral for loans on these platforms. This is a game changer because it opens up new avenues for borrowers and lenders alike. Borrowers can now use their tokenized real-world assets as collateral, and lenders can benefit from the additional security and stability these assets provide. It's like having your cake and eating it too. You get to hold on to your real-world assets while also leveraging them for financial gains in the crypto universe. This democratizes access to credit and can even help bridge the gap between traditional finance and blockchain technology. Let's consider a few examples to bring this idea to life. Imagine being able to use your tokenized real estate as collateral to secure a loan in cryptocurrency. Or consider the possibility of lending platforms accepting tokenized art pieces as collateral, offering artists a novel way to raise funds while retaining ownership of their work. In recent times, we've seen several developments in this area. More and more lending platforms are starting to accept RWAs as collateral. This trend highlights the growing acceptance of RWAs in the crypto space and their potential to reshape traditional lending practices. However, as with any innovation, there are challenges to consider. The integration of RWAs into crypto lending platforms requires careful attention to regulatory compliance, asset valuation, and risk management. But given the potential benefits, these are challenges worth tackling. In essence, RWAs are revolutionizing the way we perceive and utilize lending platforms in the crypto space. They offer a more stable and less risky option for borrowing and lending, fostering a more secure and reliable environment. With RWAs, lending platforms in the crypto world are evolving to become more secure and reliable. By bringing the stability and tangibility of real-world assets into the mix, they are not just transforming the world of crypto lending, but also redefining the boundaries of what's possible in the world of finance. Now let's turn our attention to a groundbreaking trend, regenerative finance, or ReFi, and how RWAs fit into this picture. Regenerative finance, an emerging trend in the crypto world, is a powerful concept. It's all about creating financial systems that restore, renew, and revitalize their own sources of capital. It's a shift away from the extractive nature of traditional finance and towards systems that are self-sustaining and equitable. So where do real-world assets fit into this picture? Imagine this. Instead of your investments feeding into a system that fuels inequality and environmental degradation, your money is put to work in a way that benefits not just you, but also the community and the environment. This is the promise of ReFi, and with the integration of RWAs, it's a promise that's becoming more tangible. Real-world assets, from real estate to commodities, can be tokenized and brought onto the blockchain. This opens up a whole new world of possibilities. These tokenized assets can serve as collateral for lending and borrowing, offering less risky investment options, and enabling index funds to diversify portfolios. But it's not just about investment opportunities. The tokenization of real-world assets can also contribute to regenerative finance by promoting sustainability and inclusivity. For example, tokenized renewable energy assets could allow people to invest in and benefit from the green energy revolution. Similarly, tokenized real estate could open up property investment to a wider range of people, democratizing wealth creation and contributing to financial inclusion. However, like all innovative trends, integrating RWAs into ReFi is not without its challenges. The process of selecting, valuing, and dividing the asset, creating a legal framework, developing smart contracts, choosing a blockchain platform, and issuing digital tokens all require careful consideration. Despite these challenges, the potential of RWAs and ReFi is immense. By bridging the gap between traditional finance and blockchain technology, they have the power to democratize access to wealth, enhance financial inclusion, and promote sustainable development. RWAs and ReFi together could redefine the financial landscape, creating a more inclusive and sustainable ecosystem. Capital market products are a cornerstone of the financial world. But how are RWAs influencing this space? Let's delve into this exciting topic. Capital market products are started like stocks and bonds, have always been a key part of our financial ecosystem. They provide companies with a way to raise capital and give investors an avenue to grow their wealth. But with the advent of blockchain technology and the rise of real-world assets, or RWAs, we're starting to see a seismic shift in how these products can be accessed and utilized. Imagine tokenized versions of tangible assets, such as stocks, bonds, and real estate, all brought onto blockchain networks like Ethereum. Suddenly, these assets are not just available to a select few, but to anyone, anywhere, at any time. This is the transformative potential of RWAs in democratizing access to traditional assets and unlocking new avenues for investment. So, how can tokenized RWAs be integrated into capital market products? Well, think about it this way. By tokenizing an asset, we're dividing it into smaller, more manageable pieces. Each piece, or token, represents a fraction of the underlying asset. This means that instead of having to buy an entire property or a full share of a company, you can now buy just a fraction of it. This opens up a whole new world of investment opportunities, especially for those who may not have had the financial means to participate in these markets before. Moreover, tokenizing RWAs can enhance market liquidity. Traditionally, selling a property or transferring shares of a company can be a lengthy and complicated process. But with tokens, these transactions can be completed quickly and efficiently on the blockchain, providing increased liquidity to the market. But it's not just about making existing assets more accessible and liquid. RWAs also have the potential to create entirely new capital market products. For instance, we could see the rise of index funds comprising a diverse portfolio of tokenized assets, or the development of derivative products based on RWAs. These developments could offer investors even more ways to diversify their portfolios and manage risk. In fact, we're already starting to see some of these developments come to life. For example, the total volume locked in real-world asset tokens is over $4 billion. This shows that the integration of RWAs into capital market products is not just a theoretical concept, but a practical reality that's gaining momentum. However, it's important to note that while the potential of RWAs is enormous, there are also challenges and risks involved. These include regulatory hurdles, the complexity of the tokenization process, and the need for robust legal frameworks. As with any investment, it's crucial to do thorough research and understand these risks before diving in. The integration of RWAs into capital market products is yet another example of how the crypto world is transforming traditional finance. And as we continue to explore this dynamic landscape, who knows what exciting developments the future may hold. Let's delve into one of the most exciting aspects of RWA tokenization: real estate and other physical goods. The tokenization of real-world assets, or RWAs, has opened up a new realm of possibilities in the world of finance. Today, we're focusing on how this game-changing innovation is transforming the real estate market and the world of physical goods. Imagine owning a piece of the Eiffel Tower or a fraction of a Picasso painting. Sounds surreal, right? Well, that's the magic of tokenization. By converting tangible assets like real estate and art into digital tokens, we can now own, trade, and invest in these assets in a way that was unimaginable a decade ago. Real estate, in particular, has been a significant beneficiary of this shift. Traditionally, real estate investment was reserved for the wealthy due to its high entry barriers. However, tokenizing real estate assets has democratized this sector, enabling fractional ownership. Now, instead of needing thousands of dollars to invest in a property, you can buy a fraction of it for a much smaller amount. This not only makes real estate investment more accessible, but also increases liquidity in the market. Moreover, the tokenization of real estate has other benefits. It eliminates the need for intermediaries, reduces transaction costs, and speeds up the buying and selling process. Plus, it brings transparency to an industry that's often criticized for its opaqueness. Now let's shift our focus to other physical goods. Just as we've seen with real estate, tokenizing physical goods like art, wine, and even luxury cars has created new opportunities for investors. These tokenized goods can be bought, sold, and traded on blockchain platforms, offering an unprecedented level of accessibility and liquidity. For example, let's consider art. Traditionally, investing in art was reserved for the ultra-rich who could afford to buy expensive pieces. However, tokenization has democratized access to this asset class, allowing anyone to invest in a fraction of a masterpiece. But it's not just about making these assets more accessible. Tokenization also brings transparency and traceability to the table. Every transaction is recorded on the blockchain, creating a tamper-proof record of ownership. This is a game changer, especially in industries like art, where forgery and provenance disputes are common. So what does this mean for the crypto space? Well, the tokenization of real estate and physical goods is a significant step towards bridging the gap between traditional finance and the world of cryptocurrencies. It's a testament to the transformative potential of blockchain technology and a clear sign that the crypto revolution is just getting started. The tokenization of real estate and other goods is revolutionizing how we view and interact with physical assets, further blurring the lines between traditional finance and the crypto world. So what does the rise of RWAs mean for the future of crypto? Well, the emergence of real-world assets, or RWAs, in the crypto space represents a significant shift in how we perceive and interact with traditional assets. By tokenizing tangible assets like stocks, bonds, and real estate, RWAs are not only democratizing access to these assets, but also unlocking new, innovative avenues for investment. The rise of RWAs is a clear indication of the increasing intersection of traditional finance and blockchain technology. This convergence has the potential to transform the financial landscape, making it more inclusive, efficient, and transparent. But it's not without its challenges. The process of tokenizing real-world assets involves complex steps such as selecting, valuing, and dividing the asset, building a legal framework, developing smart contracts, choosing a blockchain platform, and issuing digital tokens. Moreover, integrating RWAs into decentralized finance, or DeFi, poses regulatory challenges. These issues need to be addressed to ensure the sustainable growth of this space. But despite these challenges, the opportunities RWAs present are immense. For investors, RWAs offer less risky investment options and enable index funds to diversify portfolios. They also increase financial accessibility through fractional ownership and improve inclusion in the DeFi ecosystem. For the broader crypto community, the rise of RWAs signifies a new chapter in the evolution of the blockchain technology, one where the lines between traditional finance and crypto are becoming increasingly blurred. To sum it up, the rise of RWAs is a testament to the dynamic and evolving nature of the blockchain and crypto space. It's a journey that's only just begun, and it's one that promises to revolutionize how we interact with traditional assets. The future is indeed exciting and filled with endless possibilities. The rise of RWAs is a testament to the ever-evolving nature of the crypto world. And we're just at the beginning of this exciting journey. That's a wrap on our deep dive into real-world assets in the crypto space. If this has sparked your curiosity, we encourage you to continue exploring this fascinating intersection of traditional finance and blockchain technology. Don't forget to show your support by hitting that like button, leaving a comment, and subscribing to stay updated with the latest developments. Remember, the future of crypto is unfolding every day, and RWAs are a fundamental part of this story. Stay curious, stay informed, and as always, stay tuned for more.